Hey guys, Jessica here. So today I wanted to talk about how to get started investing. This is a super common question that we get at OnTrail, and so I thought it would be great to make a video about this and really keep things simple. This is not an hour-long seminar or anything like that, but rather we're going to be covering super simple tips, practical steps on how to get started, as well as a little bit about how to think about how investing fits into personal finances overall. So I think most people, when they start thinking about, how to get started investing, they think about, what should I buy? What should I invest in? What kind of accounts should I be creating? And even, how much money should I be putting into investments? Hold up. Before we get started on any of those things, it's really important to talk first about why you're investing in the first place. And no, we're not going to go into those super deep topics like, hey, you really want to prove yourself, you have a chip on your shoulder, you want to save the world. None of those things. But very practically, I think most people would say, hey, they want to get started investing because they want to make money. They want to get better returns than they could get just by leaving cash sitting in a bank account. Okay, great. So if the goal here is to increase returns, then the one takeaway that I want to leave you with from this video is that guaranteed returns are way better than not guaranteed returns. Pretty obvious, but what I mean by this. So one example of this is paying down credit card debt that has, say, 20% interest rate on it is a guaranteed return. For every dollar that you put towards paying down that credit card debt, you're getting a 20% return. Versus, say, the not guaranteed returns. For every dollar that you put into, say, the S&P 500 is first of all not guaranteed, and second of all has even historically not been able to return that much. Another example, going for low-fee mutual funds versus really expensive mutual funds is a guaranteed ongoing fee advantage. And the thing with these, really expensive mutual funds is that those fees are an ongoing drag on your portfolio performance over time. Therefore, when you're thinking about starting to invest, you want to go for all of these really guaranteed things first. So things like, paying down high interest debt, as I mentioned, going for low fee accounts, signing up for your employer benefits. So things like 401k could potentially give you an instant 100% return through your employer, as well as, being smart about taking advantage of accounts that can be, big tax wins. And so all of these things are guaranteed and will be a huge boost to your portfolio performance over time. So let me break this down. 4 steps. Number 1, should you pay down debt before investing? Number 2, should you build up an emergency savings fund before investing? Number 3, should you contribute to a 401k before investing? Number 4, can you finally invest? If any of these steps, in this order are not relevant for you or you've already done them, feel free to skip ahead. I'm going to be including timestamps in the description below, so check those out. All right, so number 1, paying down debt versus investing. So high interest debt, pay that down first. What I mean by this is, credit card debt and those very expensive loans, things that have interest rates like 10, 15, 20+%. So as I mentioned, this is guaranteed interest that you have to pay, that this is money out the door versus the potential not guaranteed returns that you can get from investing, which historically hasn't even returned, this much. And of course, as I mentioned, not guaranteed. So definitely pay down high interest debt before investing. So student loans are a bit trickier, and it depends a little bit on what interest rate you have. So for example, if you have a student loan that has an interest rate of say 4 to 5%, and then historically the market has returned somewhere between 6 to 9% over a really long period of time, so in that case, it probably makes sense actually to think about investing versus aggressively paying down your student loans. So if that's you, put your student loan on a payment plan that you feel comfortable with and keep watching. Number 2, emergency savings fund or investing. So the answer is emergency savings fund. And I know this doesn't sound super fun to be building up a cash balance of 3 to 6 months before starting to invest, but it's actually a super critical component of an overall investing strategy. And basically the reason is because, as we go through our day-to-day lives, there are times when sort of big lump sum cash needs come up. And so these could be things like emergencies, something happens, or maybe you're out of work for a month or two and you need cash to sort of like tide you over. But this could also be things that are just normal. So say you move apartments and you need to take 1 month's rent and put it down as a deposit. So when you have a need for a big lump sum of cash, you will want to have a cash buffer to be able to draw down on, rather than being forced to pull money out of investments at potentially the wrong time. Therefore, having 3 to 6 months of cash allows you to be more risk-taking in your other investments, knowing that you won't need that money in the short term. You would therefore be able to get higher returns over time. Number 3, 401k or investing. So the answer is 401k. And this is a bit of a trick question because 401ks are actually investing. So the reason for 401k is because the tax benefits of these things can be huge, as well as other, tax advantaged accounts. Again, tax savings are guaranteed returns, and these tax benefits, being able to deduct your investment into this account from your taxes, is an instant 30% return, or whatever your tax rate is. So once you've put money into your 401k or whatever tax advantaged account, then you'll want to invest that money. And I recommend looking at something called a target date fund. And so if you do a search for this, you'll probably see things like, hey, target date fund 2045, target date fund 2060, things like that. That year at the end of the target date fund corresponds to when you would expect to retire. So suppose you're planning on retiring in 2065, then you would look for a target date fund 2065. So these funds generally take care of sort of aggregating, within this fund, a very balanced portfolio that is tailored to your age, tailored to when you plan to retire, and are generally also very low fee, which is a guaranteed win. One really quick call out. As you start diving into looking into, which funds to invest in, I know I mentioned before that you're looking for things that are really low fee. The really annoying thing, though, is that if you search for fee, you won't find anything. And that's because mutual fund fees are actually called expense ratios. So that's a quick tip. If you're looking for things that are low fees, search for expense ratios and make sure that that number is really low. One more quick call out. So there are a bunch of tax advantaged accounts out there. So 401ks, but also IRAs, HSAs, Roth versus traditional, all of these kinds of things. But rather than go into tons of detail here, I actually recommend that you guys sign up for OnTrail. I've included a link in the description below. And the reason is because the answer is different for different people. It really depends on your situation. And so OnTrail is completely free, and basically you'll get a personalized answer looking at your situation as to which accounts make the most sense, as well as how to think about how much to be putting in each of those accounts. And that brings us to number 4. Can you finally get started investing? Yes. If you have money left over after that, then the rest can go into a normal investment account. So to get started, we recommend going with a low-fee robo-advisor like Betterment or Wealthfront, or even, you should check out Vanguard's new robo-advisor account called Digital Advisor. And the thing with these robo-advisors is that they are low fee, which is important. And on top of that, they also make sure to algorithmically put into place all these investing best practices. So things like making sure that your portfolio is diversified, and even within that portfolio that they're doing some tax optimizations on top of that. And that's it. As mentioned, we'd be happy to take a look at your specific situation, help you figure out which accounts to be using, how much to be contributing, all of this kind of stuff. We do it completely for free. You can sign up on our website, which is linked in the description below. We're a startup that is on a mission to take the personalized tax and financial optimization strategies of the rich and make it available to everybody completely for free. Other than that, if you got value out of this video, please hit the like button and subscribe for more optimizations. Thanks.